time. Now, it's true, investors back then, a lot were new, and it was a different dynamic, right? They were buying the dip, whereas right now they're trying to protect profits. So with that in mind, I want to discuss the perception versus reality, discuss risk versus reward. Joining me in this discussion, Money Map Press Chief Strategist Shaw Galani, along with Gibbs Wealth Management President Aaron Gibbs. All right, I'll start with you, Aaron. The notion that we're in a correction, where are we now? I mean, is the biggest risk to this market, in your mind, selling to avoid a correction or riding out a correction? Which one would be the worst thing to do?
I think the biggest thing is thinking that you're needing to hold on to your stocks and ignoring it. One, we're not in a correction. It's a sector rotation. And I think investors really need to grasp that, in that we've had a change in leadership. And so if you are holding on to some of those, big tech names, those mega caps that have been doing so well for the past 3 years, it's time to either take some money off the table if you're overweight and put it into the stocks that are more cyclical stocks that are better able to take advantage of a more cyclical economy where we're looking at 6% GDP growth and higher interest rates.
Shaw, now I know, like Aaron, you're professional. You can do that. Do you think the average investor should be trying to do that? Or if they have a great name, and let's say it's a great tech name and it's down, but like an Apple, do you sell an Apple? Do you take a loss on a stock like an Apple to move somewhere else where all the action is?
Absolutely not. Absolutely never, as a matter of fact. You got a company like Apple, obviously, charging. You're not, everybody's probably who's been in Apple for some time sees a small dip, if you will, or even a correction, even a bit of a bear market in a stock like Apple. If you have more capital, you buy more because it's going to go back up. All your investors, your audience, really who are investors, not traders, should never sell, because every correction that we've seen, every dip has been a buying opportunity, certainly back since 2009. Nothing has changed. In fact, that's going to probably accelerate every time we get a dip. You better be quick on the trigger to buy what you want to buy, because those dips are not going to last, so investors should not sell.
Now, Aaron, I want to give you props, because last year you were positioning yourself in a lot more conservatively than other people, and I'm guaranteed you slept better than a whole lot of professionals and individual investors right now. So again, to Shaw's point, people who are chasing, like today, for instance, it's the exact inverse of the last 5 weeks. Financials are down, energy is down, materials are down. It's a tough game trying to sort of go back and forth. Are there ideas that maybe occasionally you have core positions?
Sure. Certainly, I think, financials, adding that, because so many people have ignored that, is one of your best bets for taking advantage of the higher inflation yields. I think diversified financials are one of your safest bets, because they do have so many different revenue streams. They can take advantage of whether it's credit cards or mortgages or trading. Morgan Stanley is one of my cores that I really feel is doing well. I would disagree with Shaw in that some of these stocks that are going down, they are just about to hit normal valuations, and they can go down further. We've been in 4 years of a momentum style type of market, and it can take 3 to 4 years for that style to come back. So I think you really need to look at, are there better opportunities over the next 12 months, or do I really want to be stuck with a stock that's going to continue to underperform for the next 12 months?
Let me tweak the question a little bit then. Let me tweak the question a little bit, because let me tweak the question for both of you a little bit, because the second biggest question was about inflation. And we know historically during inflationary periods, it is energy, it is financials, it's materials that usually do better. And Shaw, you were in some of these names. I know you were in financials long before everyone else. So how do you handle that if we are in an inflationary environment?
Well, the trader in me, and I'm speaking to what Aaron said, and I agree with it. The trader in me wants to sell, take profits when I think I see something ahead that gives me some concern, as I saw a couple of weeks ago with rising interest rates when the 10-year started to spike. But the investor side of me, and I have lots of core positions that I don't touch. I prefer to add to on dips. So, but the trader in me wants to take profits. When I see something like inflation down the road, I'm looking for stocks that benefit from inflationary trends. All I'm doing there is just rebalancing my portfolio. Maybe some of the some of the money that I've made on some of the big trades, I'll take some of that off the table and apply that elsewhere and diversify a little bit into some of those more cyclicals that Aaron spoke about.
So Aaron, we know that value has overtaken growth in the last couple of months or so. And it's one of these shifts that, to your point, we don't see it all the time. You're going to ride this one out. Do you ever get worried, though, that value can become overvalued? In other words, one of the interesting things, I think, when you start talking about value stocks is the notion that, that they haven't been fully priced. But what happens when they are fully priced? Today, intriguing action, like with the reopening stocks, we got better travel numbers. We got another vaccine coming on, and yet the airlines are struggling a little bit. The cruise lines are struggling a little bit. Is there ever a time when value becomes overvalued?
Absolutely, and that's why I'm not encouraging investors to just say, go buy an S&P 500 value ETF. I think there are a lot of areas within value types of industries that are extremely overvalued, energy being one of them. And it's just so volatile. It's very difficult to time, and you really need to be a trader. And I prefer just doing longer term gains so you can avoid those short term capital gains. So, yeah, there are areas, and that's why I really want to be picky about companies that have really strong balance sheets, but are also able to really take advantage of not only inflation, but yield curve sharpening, higher interest rates, stimulus plans, all of these things, reopenings. And so industrials are another area that also are really able to take advantage of those type of long-term stories that we're going to see for the next 18 months.
You're talking a Swiss Army knife of stocks. I like it. Believe me, I do.